Hey everyone, Jeff Dorman, Chief Investment Officer at Arca, back again for another live edition. That's our two Satoshis live. Joined again by my esteemed colleague Nick Hodes. How you doing today, pal?
I'm good, Jeff. Hey, everybody.
Good. Well, yeah. If you haven't been following Nick on Twitter or haven't been reading some of his posts, Nick has been putting out some pretty awesome ideas around how to value blockchains as well as what we're dealing with in the macro environment. We'll get that back to that in a minute. But to start with, let's talk about what happened in the digital asset market this week. For those who don't know, we write a blog every week called "That's Our Two Satoshis." You can find it on our blog at ar.ca/blog. It was actually interesting, Nick. I don't know, it felt like a huge rally, mostly because the weekend was so strong. But if you actually look at week over week prices, most things didn't really move. We run everything Sunday to Sunday, so it's pretty interesting because over the last 2 weeks we had similar price action. We had an increase during the week and then a sell off over the weekend. This was the first time that we had the increase during the week and it actually accelerated further into the weekend. And I think a lot of that was driven by the ETH 2.0 narrative, which I think everybody knows is on the horizon. But we had some real positive developments last week with regard to timing. What can you talk about with regard to what was happening on some of the developer calls and where we stand with the ETH 2.0 merge?
Yeah, so I mean, if you've been following this closely, I think the developers have been moving, narrowing more and more onto the kind of September timeframe for the actual mainnet merge. All of the test nets outside of just one are done, merged, and were successful. They're doing that last test net on August 10th. It's looking like now, and after that, I mean, it's the same code. They're just gonna all you got to do is put that on mainnet. It's really going to be pretty much done and dusted as soon as this testnet is over with, and assuming that's successful. So yeah, there was some speculation. I mean, I think it was mostly an off the cuff comment, but there is a fixed date now where it sounds like the week of September 19th is when the kind of tentative date for the merge.
Yeah, so Ethereum, obviously the biggest winner last week and over the weekend. Ethereum up 34% over the last 7 days and certainly outperforming Bitcoin by quite a bit. We're back to 0.068 on the ETH Bitcoin pair, up from 0.055, just to show some of the outperformance there. But Ethereum wasn't alone. In fact, we put a chart that's almost impossible to read on our blog. We'll have to get the marketing machine over here at Arca to make these charts a little more user friendly. But we basically posted two charts. One from the lows from when Three Arrows forced selling happened. So obviously once the market found out about Three Arrows insolvency and everything that came with it from a price action standpoint, if you look at the lows there, which was middle of June, a lot of tokens are up, almost 100% or more, and almost all of them had real news associated with them. Same thing if you look at just the the sell-off last week with the CPI print, the macro print with a 9.1% year-over-year reading. Same thing, we had a big sell-off, and if you chart the gains from that sell-off to the end of the weekend, again we saw 30, 40, 50, 60% moves, and the big theme I'm seeing is that everything that's moving higher is moving for real reasons. There's been real partnerships, there's been real news, there's been real announcements. And that's good to see, right? A sign of a healthy market is when you're actually being rewarded for positive developments and positive news. One of the tokens that is absent from the big gains, of course, is Bitcoin. And I'll probably get in trouble from Bitcoin Maxis for calling it a token instead of a coin. But
I'll get into more trouble depending on what I say, so don't worry.
But yeah, one of the things that we've noticed here is that for 3 or 4 weeks, maybe even 6 weeks, we've been talking about how Bitcoin's going to struggle for a couple of reasons, right? One is that it's no longer acting defensively at all, right? It's we just saw a pretty brutal bear market, and Bitcoin dominance barely budged. You'd expect Bitcoin, if it really was a defensive investment in this market, to outperform to the downside, and it really hasn't. Two is it's clearly not acting as an inflation hedge, and I know there's nuance to that, and everybody has a different opinion on what Bitcoin is supposed to do with regard to inflation. But clearly, Bitcoin as an inflation hedge certainly isn't keeping pace with real rates or with gold or other inflationary hedges. And probably more importantly, it's no longer even really the dominant blockchain with regards to fees or transactions, and you can see this in a lot of different places, right? I mean, you can see so much more activity. At least from a growth rate standpoint, not from an absolute standpoint, happening on things like Ethereum and Solana or applications like Uniswap. One of the things I'd like to your opinion on, Nick, is like I for one love the Bitcoin asset, right? I think it's a call option. I think everybody should own it. Bitcoin the asset is a really interesting thing to own, but Bitcoin the industry is really hard to get behind because there's so many companies and people who have bet their entire careers and everything on Bitcoin that you start to get a lot of false narratives. And I don't want to pick on New York Dig, but like I put an excerpt from one of New York Dig's recent emails, NY Dig, talking about why everyone's going to rush to Bitcoin because it's the only token that has product market fit, and that investors are going to realize that most of the other things that have happened in the blockchain world are flash in the pans, but Bitcoin isn't. And I challenge that because I'm like, well, wait a minute, did NY Dig, just because they're focused entirely on Bitcoin, forget that stable coins went from 0 to 150 billion in the last 2 years, and that DeFi went from 0 to 100 billion in TVL, and NFTs went from non-existent to trading 100 million per week? There's all these positive things happening around us that don't invalidate Bitcoin, but they certainly warrant attention because they're real. And I'm curious, when you read what I wrote, before we get into what you wrote later on the blockchains, what you think about a statement like that. Do you think the Bitcoin asset itself is maybe at this point better than the narratives and the propaganda that are being ushered out there by some of the Bitcoin only firms?
I mean, I tend to agree with that. Yeah, I mean, there's definitely been, like you wrote, there's definitely been other products that have shown product market fit. Things like stable coins, definitely things like NFTs, DeFi to some extent as well. Those are clearly things that have some marketability in this space. Bitcoin is not the only thing anymore. I guess where I might disagree with you on Bitcoin, the asset, is I worry about the long-term sustainability of Bitcoin's model. Just given that it has this block subsidy that's paying the miners with the inflationary reward, and at some point it needs to create some sort of compensation for them as the block subsidy runs out, as the inflation runs out. And the kind of whole point of Bitcoin is it's this asset that you can hold and store value in, but holding and storing value doesn't generate any fees to pay the miners. So I think there needs to be some sort of, I don't know if it's cultural change or change in the roadmap or something, but there needs to be a recognition among the Bitcoin community, among the Bitcoin industry, as you said, that this is eventually going to be a problem. And if we want to have this sustainable, secure asset that's a better gold, we need to be able to support it somehow.
Yeah, I think that's 100% right. And I think, obviously, there's been plenty of bloodshed and wasted words talking about Bitcoin maxis versus ETH maxis versus any type of maxi you can have out there. I think the real thing is, for those who are objective, there's a lot of really cool, positive things happening across a lot of blockchain-based projects. And we should be embracing all of the growth that's out there and not trying to just funnel everybody to one use case. And I think that's where I get a little worried about some of the way Bitcoin is now talked about in the media, or talked about by some of these firms, acting like it is this sort of holy grail and is this only use case of blockchain. Is that, don't forget, there's $5 billion of wrapped Bitcoin out there. I mean, that's pretty much a proof of concept that people who own Bitcoin want to use their Bitcoin in DeFi and other applications to try to get more out of it. Like, you want to see these different blockchains working together. You want to find different use cases, instead of just, okay, Bitcoin is there to be held, and, we're not going to change our narrative for 100 years, even though, mathematically it doesn't work, right? There's a reason that Keynesian economists will fight Austrian economists, is that you need a little bit of inflation. You need a little bit of a rationale to get people to spend. Otherwise, you just hold forever and save forever, and there's no economic activity. So I agree with you. I think the reason I say I like Bitcoin the asset and not Bitcoin the industry is because I don't want the Bitcoin maxis coming after me. I like Bitcoin. I think Bitcoin is a good asset. I think it's done a lot of good, and I think there's a lot of reasons to own it. But I do think the people talking about Bitcoin do need to change their tone a little bit and recognize that there's a lot of growth happening out there, and there's reasons why Bitcoin is underperforming everything else right now. And that doesn't mean it will forever, but there are real reasons. There's much more traction and activity happening other places right now, and they should acknowledge that and look for ways to fix that, not just continue to perpetuate a narrative that's either false or misleading, or at the very least not living up to its expectations.
Yeah, I mean, I think there's a very real path to bring some of these products onto Bitcoin, and I just don't think that's really been acknowledged by the community. It's just kind of a, let's push it off to the side. It's kind of a scam, when clearly it's not.
Yeah, for sure. So let's dive a little deeper in that. So for we've been teasing you now for 7 or 8 minutes here, but what Nick wrote in the second half of our write-up this week, talking about breaking down layer one valuations from first principles. For a little context, back in February, Nick wrote what I think is one of the best pieces that we ever wrote at ARCA called "Are Blockchains Businesses or Nations?" where he broke down what's the best way to value a layer one blockchain. Should we be looking at them as a nation that has its own native currency, or should we be looking at it like a business that has cash flows and revenues? And over the last 4 or 5 months, Nick has, certainly adapted and evolved his opinions and wrote a follow-up piece to that just yesterday, released on our blog, which I thought was really interesting. Where do you come out now, Nick? Because I know you have a much more stronger take than you did before.
Yeah, I think I kind of straddled it a little bit the first time, but I think the core piece here is that, I was thinking about, okay, is it a business and then that means that the token is equity, or is it a nation and that means that the token is a currency, right? An equity, by definition, kind of it creates a product, and blockchains they sell block space, but it has a currency that it earns that isn't the same as the currency that, like, the commodity it's selling, right? When an Apple sells an iPhone, they earn dollars, right? When Ethereum sells a block, it earns ETH, but that's the currency that Ethereum prints, right? The only thing that does that is a government, and and they print currencies. So to me, it seems like it has to be that these tokens are currencies, and then with that comes a very different way of valuing them. It's all based on supply and demand. It always is for equities, currencies, commodities, whatever. But it's a different way of kind of thinking about it, and a different perspective towards valuing it. With with an equity, you're looking at earnings, you're taking a discount rate and kind of doing your DCF model to determine an exact value of it. With a currency, you really can't do that because it doesn't have cash flows. We kind of have to realize that these fees being paid to blockchains they're not cash flows necessarily. What they are ways of removing or adding supply of the currency, and those structural flows can change how valuable it is. So what you can really figure out about the valuation is how is the value of these currencies going to change over time. You can't figure out the exact, ETH should be worth $2,000, $2,000 against US dollars. You just don't have the kind of mechanism to value it like that.
So does that mean that we now completely ignore some of the cash flows and some of the revenues and transaction fees that you see on a layer one blockchain? Or is it just that the cash flows or fees or revenues are really just more of a means to showing off how valuable the currency is within the nation?
Absolutely not. No, you definitely don't ignore those. Those are a really important part. And so I kind of go into highlighting how you can break it down into both the supply side and then kind of the demand side to some degree. So what we have on the supply side is, if you add new supply, obviously that makes the currency less scarce, and that's bad, right? If you have higher inflation, that's not necessarily good for your currency. So that's thinking about, like, okay, a token is printing more currency for the team or for founders or for an ecosystem development fund or to pay the miners or the stakers. That's all inflationary. That's bad for the asset. On the other hand, if you have supply being burned, for example, like Ethereum, Solana, BNB, Avalanche, they all burn fees to some extent. So when people are using the blockchain and paying fees, some of that is going and being taken out of circulation. We can think of that kind of like when a government taxes a society, right? If you raise the tax rate, that is taking more currency out of circulation, and that's a good thing for the currency because you have this kind of effect of increasing the scarcity of it. And so that's where the earnings or the fees come in. They're taking, when they're being burned, they're taking more out of circulation, and that's positive. The last point that is, I said it was on the demand side, but it's kind of really a dynamic thing that mixes the two, is talking about real interest rates. And what that means is the amount that's being paid out for as like a cash flow outside of inflation, or after you subtract inflation. And so generally funds flow into currencies that have higher real interest rates because people get, you get more compensation for holding that currency. And
for example, right now the Federal Reserve is hiking rates faster than anywhere else, and the U.S. dollar is appreciating because money is flowing into dollars because they can get that higher interest rate here in the U.S.
Exactly, exactly. And by the same token, on the other side, you had interest rates across kind of the crypto space drop really, suddenly in January, February, and that's the other side, right? When interest rates are dropping in that space and then rising on the dollar space, any cryptocurrency relative to US dollar is going to fall kind of from both ends.
Right. So what you're saying is, you know, over the last 4 or 5 months, while we've seen transactions fall and we've seen usage fall, there really is, you could track it back to as soon as yields across different DeFi and blockchain applications fell, then basically you saw a capital rotation out of digital assets into other currencies like the dollar or potentially even like the euro in the end, because there were higher interest rate opportunities there than there were in digital assets. So with that in mind, what turns that around? Where do you see interest rates then rising again in the digital asset world that would attract those capital inflows?
Yeah, so something like the Ethereum merge is a great example of how you can raise real interest rates on your blockchain, right? So when the merge happens, all of the fees that were being so with Ethereum, you have some fees that are burned and some fees that are paid out to the validators, people securing the blockchain. And when the merge happens, those fees are going to be going to stakers. And so that is going to increase the amount that's being paid out to stakers, and it's a sustainable yield. It's not inflationary. So that's going to increase the real interest rate. The other point is that MEV, which I kind of discussed, it's basically like arbitrage transactions that occur on a blockchain. When the merge happens, those MEV fees are going to also get paid out to stakers. So you're increasing the real interest rate, and that's all else equal. That's going to be good for ETH, the asset.
And what does that do to applications built on Ethereum? If you start to see post the merge, when interest rates rise and ETH, the currency, becomes more valuable, what does that do to other applications that are built on Ethereum?
Yeah, I think this is something that probably hasn't been discussed quite as much because it's not necessarily as bullish around the merge. But just like we see in the real economy, in the fiat economy, when the central bank raises interest rates, we know that's an attempt to slow down the economy, right? Because it's raising the cost of capital, it reduces the amount of lending, amount of borrowing within society, and so you're not creating as many projects, and it's just overall it slows the economy down. I think we'll probably see the same thing within the Ethereum economy. So things like that are providing lending and borrowing services, Aave, Compound, etc. The rate that you're lending right now is really low on a lot of those assets, and if you can get a risk-free yield in ETH terms, at least, of 5 to 7% potentially after the merge, there's really not that much incentive to use those assets, or there's certainly a lot less incentive to do so. So I think you might see a very big shift from those kind of equity assets built on top of the Ethereum blockchain to ETH, the asset itself, and some staking products as well.
Great. Yeah, so definitely something to think through, how that affects the other applications in the ecosystem, especially some of them that are multi-chain, right? Who have the ability to allow you to use those applications across chain, like a SushiSwap, for example. If all of a sudden ETH overall activity slows down, do you see economic activity increase in other blockchains? So I've always had a theory that most applications won't be blockchain specific anyway. In the same way that if you create a great, iPhone App Store app and it does amazing, you're probably going to create an Android version as well. Why wouldn't you? If there's more eyeballs over there, why wouldn't you create two versions of the same thing for different customers? I think you'll probably see the same thing happen in the digital asset world, which is as you get successful applications, they will ultimately, build versions across chains, and/or obviously bridges and interoperability will make them useful across changes anyway. So if you do see a really big shift, I guess, in the value of the currency based on real interest rates, it'll be interesting to see how that flow of capital moves across chains into different applications. As you see that happen. So we'll see. I think everyone's all bulled up for the ETH merge. I think as the market and us have identified, it's very positive for ETH itself, the asset. As we get closer to the merge, probably have you back on here and talk a little bit more about what we expect for the applications themselves. Well, very cool. Well, anyway, I encourage everybody to go ahead and dig deeper yourself and read the blog. Again, you can find it on our website, ar.ca/blog. You can interact with Nick directly. He's on Twitter @Nick_Hodes. Always love to hear comments and feedback. Every time we put out valuation techniques on any of the assets and digital assets, we always like to hear feedback, both positive and negative, to help us shape our views. So check it out. Let us know what you think. And thanks for joining us. We'll be back again next week.
See you, everybody. Thanks, Jeff.
Thanks, Nick.